Welcome back to KTM Investing. Today we are going to give you an update on NIO and provide you with information on forward guidance, upcoming changes, and the roadmap to how the company can achieve profitability in the fourth quarter of 2025. We'll break down NIO's first quarter 2025 earnings and their future plans in simple terms. We'll look at their latest results and what the numbers mean, and the challenges and opportunities ahead. The first quarter often sets the tone for the year, but most investors and institutions that are not familiar with Chinese customs, holidays, and social norms seem to not have any idea why Chinese markets ebb and flow the way they do. We will go beyond the numbers, explore growth strategies, and analyze if it is possible for NIO to reach what most investors seem to think are lofty goals. We'll also touch on the competitive landscape, NIO's technological strength, and its first mover advantage. By the end of the video, you'll have a clear overview of NIO's current position in the EV market, and a clear picture of what the future of NIO will look like within the next 12 months. So let's dive in and get started. NIO's first quarter 2025 financial results are in, and what most investors have been talking about is the company's cash burn rate and mounting losses. So let's break down the key numbers and why there is more to this than meets the eye. Revenue rose compared to last year, showing a clear growth in demand for NIO products, and the Onvo and Firefly sub-brands have gained traction among Chinese consumers. However, NIO still reported a net loss, and that has investors on edge, and many are starting to have doubts about their investment in the company. But the thing that we have to remember is that this isn't unusual for fast-growing tech companies to suffer these kinds of losses while expanding the brand, and a prime example is Amazon. When a company invests heavily in new technology, new methods, or new models, it is usually quite capital-intensive. The bottom line is that it costs money to expand and to build out service networks and infrastructure. For example, where would Amazon be if they wanted to provide AWS for networking and web support for customers around the world, but did not spend the money on data centers prior to rolling out the product to customers? They have to spend the capital to expand the business. There is a tremendous difference between the term cash burn and reinvestment. Let's look at it a different way so we can drive the point home. Imagine you opened a lemonade stand and you had the best lemonade in town. Every week you set up your stand, you realize you have more customers than you had the week before. Then you realize you need to expand, and you either need to open up a second lemonade stand or make the current stand bigger by adding more people to help you serve more customers and reduce wait times, which will allow you to stop losing potential customers that are walking away because you took too long to serve them. Your options at this point, if you were making around $500 per month, but you are seeing that 50% of your customers were being lost because you couldn't serve them fast enough, is either expand or lose out on potential profits. If you do decide to set up a new stand, then you will need to spend some of that profit to buy a second table, more ingredients, employ another person, buy more cups, and so on. Spending that money to expand your business might seem like a waste to the person that is not seeing what you are seeing with demand for your tasty lemonade. But you know that spending that profit and making a second lemonade stand will capture that 50% that you lost to long wait times and now make you a total of $1,000 per month instead of $500. The capital you just spent is not a cash burn. It is a necessary evil to expand your business. If you had family members that helped you start your lemonade stand, and they wanted you to divide the $500 profit you made from the stand so they could get their cut, would you not try to explain to them that you are not wasting the $500 you just made, but instead trying to open another stand so their cut would now improve to a percentage of $1,000 instead of $500? Short-sighted investors see only that you should split up the profit of $500 and keep making that $500 in profit per month, and they are content with that rate of return because they think that is the safer bet. However, as the business owner with the vision and having your finger on the pulse on the demand and what you see and hear from your customers, is it not your duty to let them know that this is not ideal and advise them to have patience while you try to maximize their returns? NIO's CEO is doing exactly that. He has a vision for the company and sees that having 20 lemonade stands will yield $10,000 per month instead of the $500 his investors wanted him to settle for, by keeping the company as is and distributing all the profits and not opening any more stands. He understands that this is a short-sighted way of doing business, and that by ignoring his investors' complaints about not receiving instant gratification and not just sticking to the one lemonade stand, that they will eventually be much more successful and be more financially secure if he proceeds with his plan for expanding the business to 20 lemonade stands. I don't mean to insult your intelligence, but we have seen a pattern of a lack of patience and a lack of vision on the part of naysayers and others that think NIO's current business model has a low chance of success. This couldn't be further from the truth. This is why we felt that it was necessary to break this down in the simplest form, with a childhood memory most of us can relate to, using the analogy of the lemonade stand. China's EV market is fiercely competitive, and many think NIO will fail. However, I can say with 100% certainty that this is not the case. If you have any idea of how the Chinese operate, then you wouldn't even entertain that thought. The Chinese government typically will let companies compete for a period of time in an effort to weed out the losing entities. After it is clear which companies have risen to the top, the government will then issue an order or strongly suggest that the remaining companies either consolidate their efforts or create mergers and partnerships. NIO is a symbol of pride for the Chinese government and its people. It is a symbol of hope that was born out of the mission of the government to reduce the pollution in China. The promise of NIO is blue skies are coming, which is a promise that the Chinese people will not have to wear masks in the future and look up at soot in the sky as they walk along their streets. The other company that has the same symbolism to the Chinese people is BYD, which means build your dreams. These companies have the full backing of the Chinese government, and they are equivalent to our idea of companies that our government deemed too big to fail. NIO has faced financial troubles before, when the business was not as poised for success as it is now, and everyone thought the company would go bankrupt. However, the Chinese government stepped in and decided that the company was not going to fail, and NIO received $1.4 billion from the Hefei provincial government so they could continue operations. All NIO had to do was promise that they would build factories there. They have built 2 NIO factories in Hefei province since the agreement. So, if you are of the opinion that NIO will falter due to a lack of financing options, you are sadly mistaken. NIO will see massive delivery increases and higher profit margins in the upcoming months, due to the product results that they have achieved from their intensive focus on research and development that they are now bringing to market in what the CEO is calling their harvest phase. It was costly to research and develop the NX 9031 chip, and cost NIO billions to bring to market. And it was also costly to develop the new NIO World Model Navigation System. However, the results from spending billions on R&D has allowed NIO to accomplish vertical integration in their manufacturing process. By eliminating the use for NVIDIA chips and other third-party vendors' EV parts, NIO will save approximately $10,000 per car in their manufacturing process, and this is why the CEO is confident that the profit margins will increase to 20%. Even though the technology had been available in the first quarter, they had to use the inventory of the remaining NVIDIA chips in the current production models, as they were already bought and paid for. However, NIO will not be renewing those orders in the future, and will instead be using their own chips in all future models starting in the second quarter. The same savings will occur with the discontinued use of the current GPS, that will be replaced by NIO's own World Model Advanced Driver Assistance System. These changes will have a tremendous impact on the balance sheet, and is why the CEO William Lee Bin is so confident in his forecast for the fourth quarter of this year. Let us take a look at what this means in relative dollars and compare to U.S. car makers, Ford and GM. GM operates at an approximate profit margin of 3.2% and makes around $6 billion in net profit, and has a stock price of approximately $47. They have 961 million shares outstanding, which is approximately half of NIO's outstanding shares. GM has $134 billion in debt, which is 22 times what their net revenue is, and GM has a PE ratio of 5.2 as of the making of this video. Ford operates at an approximate profit margin of around 2.74% and makes around $5.8 billion in net profit, and currently has a stock price of $10 per share. They have 3.98 billion shares outstanding, which is 1.8 billion more shares outstanding than NIO's share offering. Ford has $157 billion in debt, which is 27 times what their net revenue is, and Ford receives a PE ratio of 8.3, without anyone sounding alarms that Ford is going out of business on Wall Street. NIO currently operates at a profit margin on vehicles of 13%, which will improve to 20% once the NX 9031 and the NIO World Model Navigation are implemented, and has produced revenues of $9 billion in 2024. However, due to expansion-related expenses, NIO reports a net loss of $24 billion. NIO currently has a total debt of $30 billion, with $1.67 billion of that spent so far on building out battery swap stations. NIO has 2.1 billion shares outstanding, and has a negative PE ratio, and a current share price of approximately $3.62 as of the making of this video. To keep this in perspective, let's compare NIO to another EV company at this same point in its journey. In 2017, Tesla was not profitable, and posted net losses that kept mounting, with first quarter losses of $330 million, second quarter losses of $336 million, third quarter losses of $619 million, and fourth quarter losses of $675 million. Fast forward to 2019, by the fourth quarter, Tesla still suffered a loss of $862 million, and then in 2020, Tesla posted a profit of $721 million. Their vehicle margins were 18%. Their goal that year was 500,000 cars in sales, and many thought Elon Musk was dreaming. They sold 499,550 cars, just 450 cars shy of the mark set by Elon Musk. Elon Musk knew what investors and Wall Street analysts didn't know then, just as William Lee Bin does now, and he has laid out his projections and margins for 20% with profitability occurring in the fourth quarter. Wall Street can only guess what these CEOs already know to be true, because they are the ultimate insiders that know every detail of their company, and they are in a unique position to identify what costs can be eliminated and how to attain profitability. Let us go back to our lemonade stand analogy. If you realize that instead of making a profit of $500 per month, that you could increase it to $700 per month, and you could do this by growing your own lemons instead of purchasing them, sourcing the exact same sugar you use but from a cheaper source, and getting cheaper plastic cups by buying them bulk at a wholesaler, would you not be able to confidently tell your investors that when your lemon tree bears fruit, and this batch of sugar from your old retailer runs out, and that you found cheaper cups to cut overhead costs, that you will deliver more than the $500 a month in profits? Imagine how silly you would think they are if they could not see this logical conclusion from what you just explained to them, and instead, they started doubting your ability to run the lemonade stand, and threatened to sell their shares or even want you fired or replaced. This is currently how investors and Wall Street are treating NIO while on their path to profitability, and it seems quite silly if you look at it from a different angle and try to see what the CEO sees and what he knows about the inner workings of all the deals, partnerships, and agreements that are in place to make his vision a reality. Currently, their two main factories in Hefei are central to this plan, and a third factory is set to be in operation by October 3rd of 2025. Expanding sales and service networks, especially internationally, is also key. NIO is already in several European countries and plan to enter more. Each new market brings unique challenges, from regulations to consumer preferences. Strategic partnerships, like those NIO has developed in Asia, Europe, and Africa, will help accelerate NIO's growth. Success depends on managing production, expansion, and the partnerships progressing in a mutually beneficial manner. If NIO pulls it off, it could be transformative for the company and its investors, and it will financially change many lives. But many investors are still asking the question, can they really hit that target that they promised in the earnings report? Well, let's see what the Wall Street experts think. Analysts are split on whether or not NIO can deliver 50,000 cars a month in the fourth quarter of 2025. Optimists cite NIO's strong brand, battery-swapping tech, and new models that are set to start rolling out in the second and third quarter of 2025 as reasons for hope. If market conditions cooperate, and NIO continues to execute well, then many feel the target is possible. Skeptics point to fierce competition, supply chain risks, and the challenge of scaling production so quickly. But the Chinese government has already given instructions to the industry to consolidate and end the price war, and NIO has already vertically integrated their supply chain, so all production is now done in-house, and their third factory will be completed by October of 2025, so all those concerns have already been addressed. Some may point to the tariffs and how that might affect sales. However, that would only apply to America, and NIO does not currently sell any EVs in the US, and has no intention of doing so in the near term. The US made up only 4% of the EV market worldwide, so it is not a big loss for NIO if they don't enter the US market. The United States has a population of roughly 340 million, while China has 5 times that number. The US makes up 3.6% of the world's population, so the addressable market outside of the US is the other 96.4%. We tend to forget that even though America has the highest GDP, we only make up 26% of the world's economy. Although this is an impressive number for any one country, it means there is 74% of spending that doesn't come from the United States. This is the market that NIO aims to address. Launching new models like those from its Envo and Firefly sub-brands will be a test. Success depends on flawless execution and keeping up production to satisfy its strong demand. Given all the uncertainty in the political arena, investors will be watching monthly delivery numbers closely. The path is uncertain, but the ambition is clear. The global shift to EVs means big opportunities for well-positioned companies. And for risk-tolerant long-term investors, NIO could be an attractive bet if it navigates these challenges. Remember, this should not be taken as financial advice. Always do your own research or consult with a financial advisor before investing. Review NIO's financials, analyst opinions, and market news to see if NIO fits your investment goals. Don't forget to give us a thumbs up if you liked this video. Thank you for watching, and we will see you in the next video.